Hi, I'm Peter Grant and I'm going to do my very best to try and explain the tax changes which are coming into effect now or being planned to come into effect in no more than 2 minutes. I'm not a tax expert, which helps enormously, but I'll try and explain the bottom line impact of what's actually happening. The first one is to do with the 3% government surcharge when you buy a property, and that's come into effect already. And what that will actually do to your yield is it will shrink it by basically 0.2%. So a 6% yield becomes a 5.8% yield, a 7%, a 6.8, etc. And balancing off from that, the charge will be deductible from tax, from capital gains tax in the fullness of time, is point number one. And I actually have the sneaking suspicion that actually what will happen is that rents will actually rise. Because if even a small number of buyers are just not going into the market as a consequence of this, then with demand ever increasing, then a small increase in rent will more than offset the drag effect of the 3% surcharge on yields. The second thing to touch on is the 2021 tax changes to do with allowances and tax deductibility, to use that word. And the first category of client to think about is cash buyers. Cash buyers will not be impacted at all, so no effect on you whatsoever, is point number one. If you are someone with bank gearing and fairly high bank gearing, then the bottom line answer is that roughly by 2021, you want to get to 60 or 65% LTV to hit the kind of sweet spot. You could still, of course, run your portfolio higher, but that is, I think, probably where your general direction of travel should perhaps be. And I'm pleased to say we've got a financial model. If you're inclined to look into it, then we can help you by passing you the model. You can input all the figures and get the very accurate information for you and your own circumstances. Thank you very much indeed. Tax in 2 minutes.